Hello and welcome to the Beats Roundtable. Today's Monday, November 25th. Happy almost Thanksgiving. Our group is here and ready to talk the markets and their best investment ideas. So with us today are Jeff Mackey, Robert Marson, and Charlie Peabody. I am going to cold call Jeff because I didn't work out an order ahead of time and ask him what he's looking at. It's endless retail earnings for us. Earnings season never ends. What are you looking at this week?
This is a magical little weird week of the year. And if you're having a good year, maybe ignore this week a little bit. But man, if you're playing catch up and you're looking to whip them around a little bit, or you're an adrenaline junkie and would rather not spend time with the in-laws, this can be a tremendous trading week in a lot of different names that are reporting, particularly in retail, because the third or fourth week of November, you typically get these kind of lesser retailers. And I say mall retailers giving up for dead. We have Nordstrom this week. We have Kohl's this week. Bed Bath and Body Works, which I always call Bed Bath and Beyond. They reported this morning they're up 15%. We're seeing huge moves in names that people have really given up for dead. Macy's actually canceled their earnings because they found that just a single employee apparently had understated shipping cost was it, inventory cost per it by just about $150 million, and that's going to materially affect earnings. The stock is barely down. And so this group, even though consumer discretionary is making all-time highs, people love to just say, it's Tesla, it's Amazon, blah, blah, blah. But we've seen a nice little rally in some of these names. And more to the point, for trading purposes, we've seen a lot of them that have been sold out, given up for dead, having a nice little comeback. And Target scared the hell out of people. And that catalyzed it shook out all the weak hands. And it turns out, I hate to say it, but Target sucks. The other retailers are reporting what you would expect. And so we saw a nice reaction in Gap. I'm looking this morning, I'm trying to buy, and apparently I'm not the only one with this idea, because we've seen Best Buy, which everyone's given up for dead, but they have a real habit of last quarter. Remember, a lot of skeptics going into that quarter, the stock spiked 20%, got all the way to 100, drifted all the way back. Been trying to buy that this morning. It's already up 5% because, again, no good idea occurs in a vacuum. I've been trying to buy some Nordstrom. I think they're going to report pretty good numbers based on what we saw from Macy's. I think they'll be better than Macy's, and expectations are similarly low. These are not terrific companies, but when you get these thin weeks and names that people are over shorted and have given up for dead and are looking for kind of FOMO ways to catch up, you can see some nice moves here, and we're already seeing them. And again, nobody's expecting terrific things from Best Buy, but it's a really well-run company by terrific management, and they've come a long way. Dick's is also reporting this week. I'm a buyer of any of them if you get weakness coming in, and as we stretch out over the next couple of days. And I really like Nordstrom here. I think they'll be terrific. Again, that's getting eaten into pretty well as we speak. But if you get an opportunity on a dip, I'm looking to gather some shares, maybe even some calls.
Mm-hmm. And another one that's up this week is Abercrombie. Any thoughts there?
Tons of thoughts. So very many thoughts on Abercrombie. It's actually established a nice base. They haven't done a ton wrong. You think of that as one of this year's losers because they're so far off the highs, right? They got all the way up to 200 and went down to the mid hundreds where they've been residing since. I think Hollister is going to be good. I really do. I think that's been the hidden gem. And so we're not going to see that earnings contraction. And if you don't have a substantial margin or earnings contraction out of Abercrombie tomorrow, they're going to beat and they're going to report really good numbers. How will the street react to that? I don't know. They've been kicking the crap out of everything Abercrombie said. Again, you would think that they've missed quarter after quarter, and they haven't. They've actually turned in pretty terrific quarters, and the street either has alternated between not caring and just kicking the living hell out of Abercrombie every time. But this is a story that if they hit their Christmas at all, even Gap-esque. Again, it means a lot that the Gap was able to comp in 4 of their 5 divisions positively. They're not that good historically, and we have mall traffic. It's just a matter of whether they've been able to close the deal. And I'm not sure how people are going to react to Abercrombie. It's a little bit of a jump ball, but it's a reasonably valued stock that has suddenly been in the mid 100s for about 6-7 months. And if you haven't been long before, it's worth a sniff.
Mm-hmm. Moving on from earnings, I'm curious, Jeff, what's your Black Friday ritual? Do you have something that you do every year on Black Friday to take the pulse?
Yeah, weirdly enough, and just yeah, some of my favorite pictures of my kids are just goofing off on Black Friday. We would go every morning and in a now closed shopping mall in San Francisco. The logic is not because we're total weirdos. The logic, at least as far as I'm concerned, is that's the last time you get to see how a store really wants to look on Christmas. After Friday, they're just repairing it as they go. If the store is doing any traffic at all, it's just constant cleanup and constant sort of we're out of this. The hot items are going. It's they're protecting their losses after Friday. But Friday's going to be if you're looking to see what a store wants itself to be. What are they going to stand for? Are they going to be deep markdowns? What are they promoting this year? Friday morning is it. And so we typically go out to the mall. We don't go at dawn anymore because no one goes to the mall and you walk around alone. But yeah, it's a little bit of a family thing. We've been known to spend a Friday or two out at the mall bright and early getting our coffee and me just lecturing endlessly to the kids about what looks like good resale and what looks like bad.
Do you go to the same one
Remember,
every year now in the San Diego area?
we'll probably go to the UTC. They don't open that early, but yeah, that's the best mall out here anyway. And the it's cool. You know, I mean, it's remember when Lulu used to have a DJ on Black Friday? It's Lulu won the Christmas season for honestly 4 or 5 years in a row. It was incredible. That energy is obviously not there anymore. Everyone's online and watching football on one of our streaming services. It's still worth checking out just to see what the stores want to be. And it's a good time to talk to management and just do a finger, check how traffic is, see how the winds are blowing.
Last year, the DJ for me at the Garden State Plaza was at Aritzia, so we'll see
Oh,
whether or not
really?
there's a big party. Yeah, yeah.
There's
You know,
Canadian guys. I'm along them, love them. That's an amazing little store.
the thing that I'm looking to most forward to checking out is the line to get into the UGG store, because last year when I did all my checks, I put it on Twitter and I was like, these are the winners and losers, and my number one winner was UGGs because they had a line going down the mall to get in, yet they had literally nothing on sale. And they had a list of everything that they were already sold out on outside the store, which was nice. So we're going to see
Glorious.
that they can repeat that and come out victorious yet again. But I'm an idiot for not buying Deckers after that experience. I know you did better with that one. But anyway, big week for retail. Let's shift gears a little bit and move on to Robert, who's got a pipeline company for us today.
Yeah, another snoozer today, but decent returns with low risk aren't that unexciting anyway. If I could be accused of doing uninteresting stocks, like one of our colleagues once said, it's only because I still get nice returns out of them. And this is a nice return situation. It's not going to get anybody rich. It's not anything you want to chat about at your cocktail party. Hey, I got this exciting oil pipeline company. But we're in a very extended market. And as everybody on this show knows by now, I try to buy bad charts or underperforming stocks or too cheap to be true stocks. And quite frankly, the list of those candidates is getting pretty thin. I think the markets are in a great period to hold. I'm not selling a lot. I did grudge stock a position last week at 54. It's 70 today. I grudge sold it because I only owned a 1% position. I was mad that I only had a 1% position, but I didn't sell much, and I'm just letting this thing ride. So I'm not going to come out with sells yet, but if I have to buy one of my, I think Plains All American is probably one of the best ones to buy. It's a oil heavy pipeline company, probably the best oil pipeline system in Texas. It's a cheap stock. It has a nice 7.25% dividend yield. It's got one of the better balance sheets in the industry. It's not the best pipeline company in the United States, that's for sure. They've had their fair share of blunders, but that makes it, one of which is they have a lot of spare capacity because they overbuilt. So when you screw up and overbuild, you got a lot of capacity. And these guys have maybe 30, 40% capacity in a lot of their pipelines that they talk about. So that's good for them if they can ever fill it because it's all incremental profit. Or it's also good for a bigger, much bigger acquirer that could do a lot more with Plains Pipeline and Plains themselves. So this sort of makes the if you go to the big ones and say, if you had an ideal acquisition candidate, who would it be? And Plains is always on the list, but they've never been up for sale, and it would probably have to be a hostile deal. But the fact that it's very cheap, has a very good balance sheet, has spare capacity, makes up for the fact that it's not the most dynamic management team or growth pipeline company out there. The market for these pipelines has bifurcated into oil heavy and natural gas heavy. And we all know why you'd want to own natural gas heavy for the electricity play, right? And the AI play and all that. And I've mentioned other pipelines here. I think all of them have done well. I've mentioned Plains twice here in the last year, and the stock's the same price. So it's been a dog, right? Same price. Most companies have gone up this year. Plains hit a little lack of growth spurt, let's call it. They're going to have a flat year ish this year, a little bit growth in EBITDA, and maybe next year. They had to reprice some very lucrative contracts that were priced at $3.50 a barrel. They had to price them at $2. They lost a lot of EBITDA when these contracts roll over, and they lost the growth of a year or two in EBITDA. They didn't lose actual EBITDA, but it made the company less than exciting. So you're in oil, that's the lesser of the exciting places for here. Even though in Marathon, MPLX, I've done extremely well and just talked about that a couple of weeks ago, and it's up another 5 to 10% since I talked about that. But this company, here's the investment story. I finally get around to the investment story. I like the setup in this business. The setup's important, Berna. So it's a $17.75 stock. It's probably the same price I recommended it both other times. And they have a $1.27 dividend. And that's not bad today. It's definitely good, but it's not great. But in 13 and a half months, it's going to be great because they intend to raise the dividend. And they announced the dividend the first week of January for that following year. They intend to announce it at least 30 cents. And my guess is 40 cents in 1 to 2 years. So I don't know if they'll do a pull forward of the 26 dividend this year. They might because they're getting frustrated at the stock. But they said they would raise the dividend at least 15 cents a year until they got to a 1.6 times coverage ratio. So that means that they have committed to raise the dividend 30 cents. I think they should do it all in the first week of January. Why dick around? That makes no sense. If the dividend's going to go to 157 and you've told people I'm going to do it in 2 years, why just not do it in 1 year? I think if they wait 2 years, they'll do 20 cents a year instead of 15. They did 20 cents last year when they said they would do 15. So you could get a 40-cent dividend increase in 13 and a half months. So that's a 9% dividend yield right now. And that I know is definitely too high for this market and these interest rates. So if you're willing to play total return game and it's a 7.25% dividend, maybe it's 8, maybe it's 7.25, the terminal yield in 13 and a half months. But that would give you a significant bunch of appreciation, about 12% a year, and your 8% a year dividend. So this is a 20% per year return in probably 6 quarters, I would guess. So that's a nice return.
And it's the only way things go wrong here is if you get a material move down in oil prices and ultimately like their toll resets lower. How do you lose money here?
Well, their tolling contracts are obviously spread out over 5 to 10 years, and they're always coming due. So there's the risk in any 1 year is a certain percentage of their fee structure, right? So that's not the biggest risk, but you are right. If oil goes down, everyone goes to they don't sell these like they sell the oil service stocks. The oil service stocks they pound. These things they just forget about, and they might drift lower. But it won't affect 85 or 90% of their revenue is fee based right now and locked in. So they're not going to lose. They'll lose conceptual appeal. They might lose a little bit of income. They might lose volume growth because if we're back to drill baby drill. And I saw today, I heard someone on CNBC, there was an energy proposal by the Trump administration to add. I heard them talking about 3 million barrels. And I guarantee you that's not going to happen. Over 4 years, maybe 1 million barrels, 200,000 barrels a year, something like that, 300, but not 3 million barrels in 4 years. That I don't even know if we could do it, but the oil companies won't shoot themselves in the foot that way. So lower oil prices is not great for pipelines, but they're not as leveraged as Exxon is, and they're not as levered as Schlumberger is to lower oil prices. It's
Mhm.
just that psychology turns negative even on the pipeline companies when that
I'm
happens.
going to ask you a question about that headline that you mentioned because I think it's an interesting topic. What control, if any, does the government have over these private companies and their capital expenditure plans on drilling? Because you can open up the regulation on different fields and allow things, but ultimately the capex budgets are controlled by the E&P companies, aren't they? Is there anything
Correct.
they can do to spur them to invest materially? Because we've been in this cycle since 2016 of buybacks over exploration. And, you know, what can the government really do to change that?
I did a part of a show on this last week, just addressing drill baby drill. And it's silly if the government thinks they could force oil companies to increase their production. Now, can they pay them, incentivize them to increase their production? I don't think there's anything they could do, barring massive subsidies, which politically would be unfeasible. So no, I don't think I'm not gonna hedge here. I don't think there's anything the government could do to stimulate drilling other than that which they would do to maximize shareholder value. The
Mhm.
companies would to maximize
Right.
shareholder.
So it's going to be dependent on the price. I just think it's interesting. I think it's one of those issues that when we go through the political season, it's one of those things that people like to talk about, but government doesn't really control. So it's one of those
Right.
myths out there. It's interesting to address. So, so
I
when you,
assume I assume Trump will do a fairly large strategic petroleum reserve purchase that Biden emptied to keep oil prices down and gasoline prices. It was not intended to be used for political purposes, and it was. And Trump has said he wants to refill it. But I didn't look into this. I heard Kramer saying that there's some issue with the capacity of the SPR now, and they could buy it, but they can't get it to where it was before. So there's an issue with how it's functioning. So they may have
Mhm,
damaged it in drawing it down so much. I have to look into that.
mhm. Got it. So these pipelines, do you think of these almost as sort of bond substitutes in your portfolio?
Well, you took the words out of my mouth, Berna. For me, they're my fixed income portfolio, and that's how I
Okay.
think of them. Yes.
Yeah, that's how I've thought about them too. So I was just curious because the yield and all that. Okay, so as we talk about yield, I think that's a good time to switch to Charlie, who's got some thoughts. We finally have a winner in the Bake Off to be Treasury Secretary. What will this mean for the financials?
Yeah, so I did want to talk about the Besant trade because I think there's some subtle differences between the Besant trade and the Trump trade. And as you said, on Friday after the close, Scott Bessent was appointed Treasury Secretary. And his motto has been 333. We're going to get the deficit down to 3% of GDP. We're going to grow GDP at 3%, which is not far from where we are these days, 2.5 plus. And then we're going to, as Robert pointed out, get the companies to add 3 million barrels a day of oil production. Um, and so all of those, plus his stance on tariffs, have people believing that inflation is not going to be the issue that they originally thought under the Trump trade. And so it's very likely we get some kind of short-term trade in the 10-year where, we bumped up against 4.5% on the 10-year, and now it's possible we could move back down towards 4%. And so you get an interest rate backdrop that is more favorable for some companies versus the inflation trade that was playing out earlier under the Trump trade. So there are a couple of ways to play this interest rate rally. One is the regional banks clearly are favored in a lower rate environment over the money center banks. And the two that I would highlight are Citizens Financial, CFG, and US Bank Corp. Both benefit from having put on interest rate swaps that lock in higher yields and benefit if rates go lower. Against that trade, I would actually sell tactically Wells Fargo because they are not a beneficiary of lower rates. So if you want to put up a pair trade, it could be short Wells and long US Bank Corp type of thing. The other trade, and this is going to, we'll see tomorrow, is the home builders. I've been negative the home builders and still am secularly negative the home builders. But I think you could have a nice trading bounce here. Tomorrow we get the new home sales data, and it should be quite strong year over year, one of the strongest improvements year over year. It'll also show that the home builders are building share. Now, I want to point out the numbers are still going to be weak on a historical basis, but they'll show improvement. And that's what we saw in the existing home sales last week. And I previewed that as well. So if we do get lower rates, that's one of the things that would help to alleviate some of the incentive requirements that the home builders have to provide the consumer in order to buy their product, because the big incentive has been mortgage buy downs that has hurt their gross margins. So I could see the home builders rallying, but D.H. Horton, our tech guru, Kevin Baker, has talked about D.H. Horton rallying back to 180. And if it got back there, I would certainly short it. But yeah, I could see the home builders rallying into the new year, and some of these regional banks rallying into the new year if we get this rate rally on the long end of the curve.
So just to go back, those are very logical lower rates sooner trades, the home builders and the regional banks.
Oh,
It's into the idea that what is it about him that makes people more confident that rates are going to come down? Is it that focus on the deficit?
Yeah, I think it is the deficit, and I want to come back to that. But also, he's much more measured in how tariffs should be used. He has not really supported an across the board increase in tariffs of 20% or 60% on China. He's more in the layered and using it as a negotiation. So I think that approach on tariffs is distinctive from Trump. He's also considered a fiscal hawk. He has obviously a tremendous knowledge of the macro trade and the geopolitical trades, because he was at Soros was one of the people that took down the Bank of England. So he has there's a lot of confidence in his market knowledge. Now, one of the things he faces that's going to be very difficult for the long end, and I'm a big believer that the long end's headed to 5% next year. So it may go 4% short term, but I think we have higher long-term rates going out into 25, 26. He has to term out the debt. So under Yellen, Treasury Secretary Yellen, she took advantage of the excess liquidity in money market funds and issued a tremendous amount of T-bills. And we have to term out that T-bill issuance. We've got about 3 trillion of more debt to issue here in 24, and we've got 7 trillion next year and 5 trillion in 26. And we have to term out that debt. And that's going to be tough because the weighted average yield on our treasury portfolio right now is about 2.6%. And those yields are going towards 4%. We came in last year with interest expense being about 800 billion of the deficit. It's probably going to rise to 1.5 trillion over the next year or two.
So that's a huge headwind in getting the deficit down.
It is. But right, I'm just talking about what's going to play out this week, Berna.
You're talking about the very short term. You're not talking about next year.
Yeah, I'm talking about a holiday shortened week that's illiquid, and people are excited about Bessent.
So you're talking about a short-term trade. Your view, which has been pretty consistent, of higher rates for longer in the bigger picture, and the caution that means about things that people buy that need to be financed, whether it's houses, cars, construction and renovations on their homes, etc., boats, all that, you continue to still be on that.
But as these markets are very volatile, positioning plays a big role, and a pretty good rally this week into next week on the home builders would not shock me. If we get the backdrop,
but you're not buying any leaps on them.
I'm not buying them, but I'm probably the wrong person to ask.
So are you seeing any back off already on the tariff language? Because we've been operating on the 60% for China and 10 to 20 for every other country on the planet. Do you think it's realistic that might not happen?
I think it is. Bessent is well on record that he's not an across the board type of tariff promoter. Now, at some point, you have to Trump demands loyalty, and is Bessent going to just step into line and do what Trump asks? I don't know how to answer that question, but in the past, he has talked more about layering on tariffs rather than across the board tariffs, and then using them more for negotiating purposes. I might mention one other thing, because Bessent did an interview after he got appointed Treasury Secretary. And in that, he obviously said, I'm going to support all the Trump policies, and my priorities will be his tax policies. And he talked about extending the 2017 tax cuts. He talked about no taxes on tips. He talked about no taxes on Social Security. What he did not talk about, was left out of his comments, was cutting the corporate tax rate from 21% to 15%. And I've been getting questions from clients, because that's a big part of the upside to bank stocks and bank earnings. Is that priority being put on the back burner? And we're not going to find out until we get into the first 100 days of Trump's presidency. But if that does happen, if we don't get that tax cut, then some of these bank stocks could correct rather nastily in the first or second quarter of next year.
Interesting. Yeah, so that the many priorities on the tax cutting front versus the 333 plan on the deficit seem to be potentially in conflict. So we'll have to see how that plays out.
Well, that we're going to make America ambiguous again, right?
We're going to make the markets uncertain again, which is probably the only certainty in the markets, is that they're completely uncertain at all times. Anyway, I think that's it for us today. I'm gonna call it here, and thank you for joining us at the Beats Roundtable. If you liked what you heard today, come check us out at wallstreetbeats.com, where you will find our real-time chat and call transcripts and written research. So thanks for joining us today. I'm Berna Barchet, and we will be back tomorrow.
Thanks, Berna.
Thanks, guys.
Thanks, Ben.
Good show, guys. 1 month till Christmas. Time to do